In this video, we're going to run some backtesting algorithms on Bitcoin to US dollar tether to try to answer the question, does Bitcoin's price have a memory? And if the market has a memory, can we use that sequence to predict what the price direction of Bitcoin will be in the very next hour? And we're going to compare Bitcoin to another cryptocurrency too, which is a lot less liquid, to see how that prediction holds up and if we can gain some kind of edge in the market by doing that. We're also going to look at a quantum computer, a real quantum computer. I'm going to run a real simulation on a real quantum computer to try to convey what I believe true randomness really is, and that the markets surely can't be truly efficient. For example, if we knew the exact position, the momentum, the velocity of the roll of a dice, the viscosity in the air, the weighting of the dice, everything, if we knew all of that, could we predict with some degree of certainty what number the dice would land on? Well, I think we can do better than that in the financial markets, and that's what I want to talk about today. So first of all, let's look at this electron. Right now next to my head, you will see an electron just hovering around there in a state of what's called superposition. This means that the electron is in both an up state and a down state, a spin up state and a spin down state, a true state, a false state, or a zero state and a one state, however you want to think of it. It's in a superposition state of both 0 and 1 at the same time. It's only when we measure the electron that it decides to be in a spin up or a spin down state, in this case a spin up state or 0. If we were to run the simulation again, you'll see that the electron is now in a spin down state or a 1 position. The very nature of the electron deciding whether it's going to be in 0 or 1 is truly random. So let's jump onto a real quantum computer and see this weird, bizarre phenomenon play out in real life. Okay, so right now we're looking at a quantum circuit, a real quantum computer, if you will. But before we do that, let's quickly look at Bitcoin's price, because what we're trying to do is we're trying to say, can I predict with any degree of certainty whether Bitcoin's price will be up in the next hour from now? And that's looking at the current close price and saying, okay, will the close price in the next hour be higher or lower than the current close? And if I could just predict that alone, well, I could do very, very well. So I'm looking for that edge. That's the whole point of this, is I want to see, is Bitcoin's price movement truly random? Does it really follow a random walk? Because anything which is completely random, surely you could not predict. So it would be absolutely pointless trying to predict whether Bitcoin's price will be up or down in the next hour. But let's take a look at what true randomness really is. So here we're at this quantum circuit, and you'll see here we have this qubit, which is starting here at a 0. And it's in a 0 state, and if I was to measure it right now using this measuring device, you would see the probability down here of measuring a 0 is 100%, because there's no magic happening. Right now we have a 0 coming in, we measure it, we get out a 0. And you don't need to understand quantum computing to get that point, or any computing to get that point. Computers work with zeros and ones. If we're doing nothing fancy with a 0 and we measure it, we're going to see a 0. Now, what's interesting about quantum mechanics is we can add in this Hadamard gate, and we can put this 0 into superposition. And what you'll see here is it's predicting that it will get a 50-50 probability distribution of being 0 or 1. What that means is when we measure this subatomic particle, whether it's an electron or a photon or whatever it is, and we are measuring the spin, for example, when it decides, when it gets measured, it has to make a decision. Am I in 0 or am I in 1? Am I in spin up or am I in spin down? And the way it does that is, well, pretty much completely random. So what I'm going to do is add a measuring device onto this. You can ignore the probability. I want to actually set up and run this. And I'm going to look to run this on, it's pretty busy at the moment tonight, so I'm actually just going to run it on the simulator computer for now. And I'll show you one that I've run on a real quantum computer too. So let me just go here to the jobs, and you'll see here it's just completed. So when I look at the results, we see 519 goes, it was a 0, and 505 goes, it was a 1. And if I go back to November the 24th, you'll see here's an IBM RMonk. This is an actual quantum computer, and it got 535 as an output of a 0 and 489 as an output on a 1. Now, there's no maths that I'm aware of that I could use to have predicted that, right? This is truly random, and you can't predict
true randomness. So how cool is that? We're using a real quantum computer here to demonstrate true randomness. So we need to go and predict, will Bitcoin's price be up or down in the next hour? So I'm going to actually go here to the data builder tool. I'm going to use Crypto Wizards for this, sorry. So I'm using Crypto Wizards for rapid fire testing. I built this so that I can actually do this kind of stuff right from my mobile phone. But if you know Python, especially, you'll be able to do this without being on Crypto Wizards. You can pull data from Yahoo Finance or Binance or whatever, and you can add in any transformations or put it through machine learning or put it through backtesting. There's loads of videos on YouTube, etc., that can teach you this kind of stuff. And I'm even looking to put together a course to kind of consolidate all that. But for the time being, let's just go with a platform because it saves us time. So I'm going to use crypto data, and I'm going to take Bitcoin data here. So Bitcoin to US dollar tether, and I'm going to go as far back as April 1st, and I'm going to choose hourly data. And I'm going to say this is BTC and get data. So now that it's pulled the data, I'm just going to select here to go to the data engineer and refresh the file so I can see what's going on. So you'll notice if we go to view data that you can see the open, high, low, close, and this is coming from Binance, so it gives you some extra information about Bitcoin, including the number of trades, etc. for each time step. So this is for each hour. Now, if you want to, just very quickly, by the way, you can download this into Excel as well. So if I click on the down arrow, that should just download the file, and then you can go and work in that file. You can put whatever formulas you want on it, and then you can re-upload it if you want to, whether it's at Crypto Wizards or whether it's at Google Colab or whatever you're using. You could re-upload the file, but I don't want to do this with any coding. I just want to do it bootstrap, brass tacks, and get on with it. So I want to add some technical analysis. Why not? Because everybody looks at technical analysis. I don't believe it's very effective, if I'm honest with you, but I'm going to add it anyway. So let's add a bunch of TA to this data. I'm going to add, RSI first, and then I want to add, let's say, volume, the money flow index. I'm going to add that in. And then in terms of volatility, probably Bollinger Bands. What I like about Bollinger Bands actually is we are looking at standard deviations, etc., and I think that's kind of useful. And then I'm going to add in maybe MACD, because that's a very popular one. I could add in moving averages here, as many as I want to, really. And then returns, this is something I always add in to every data set, is just the daily log return. So it takes the close price, calculates the log, and looks at the return of that, which is very useful for machine learning. So I'm going to add that in too. So one of the things that I then want to do is I want to go and add some time sequences to the data too. So if I refresh this, just so you can see what's going on, and go to view data, you'll see it's added all these columns, MACD, Bollinger Bands, etc., daily log return, and it's added all of this to the data set. Now here where you see missing values, that's just because there's no data in the past. This section is giving us the top 5 and the bottom 5 results of the whole data set, right? So the top 5, where it's calculating moving averages going back in the past. Obviously at the top of the data set, there is no past. So we'll remove all of this from the data set in a moment. But the first thing I want to do is actually go and say add on maybe, I don't know, number of trades in the daily log return. I'm going to hit this time clock. What this allows me to do is just add in the sequence. So in the data, I'm going to add in what was the previous day, what was the day before that. And when I say day, sorry, I actually mean hour, because we're running hourly data. And I'm so used to saying day. So if I say day, I probably mean hour. But I want to look at the previous hour, the hour before that, etc., etc. And I want to add that into the column features so I can feed that into a backtesting model, into a machine learning model, and have that extra information just in case there's a pattern there. I'm also going to remove any missing values or not a numbers from the data set that we just talked about and just add those in. So once that's done now, I'm going to go and refresh our data set and take a look at what that looks like. And you can see now we've got these historical time steps. So I've got the daily log return T1, so that's one step ago, and you can see that this same price 0.11 or the same log return 0.1111 keeps moving down a step basically, and that's because it's going back 5 time steps. And I've done the same for the number of trades. Just I could have used volume, I could have used anything. I'm just experimenting here. So there's just one more thing I want to add to this data set before I go running all sorts of algorithms against it, is I'm looking at this close price and I just want to predict the price direction. Is it going to go up in the next hour, or is it going to be the same or go down? If it's going to go up, I want it to put a 1 in a column next to the close price if the next hour went up. And if it went down, I want it to put a 0. So for example, here 59,621, it actually went down, so this should be a 0. Here it was 59,597 and it went down to 542, so this should be a 0. So let's go over to the ML trainer, because we can actually add 0 and 1 prediction columns without having to download the data. So I'm going to go and do that here, but you could just as easily write a formula in Excel and re-upload it again, whether it's here or Google Colab or whatever you're using to write Python. So here I'm going to choose the close price, and if it's lower than the close price, 1 time step down from now, in other words, 1 time step in the future, in other words, 1 hour in the future, then it'll put a 1. And I wanted to basically label this column as outcome. So I'm going to add that in very quickly. And just for your benefit, just go back and take a look at the data set so you can see what that actually looks like. So if I go to view data and go to the very end, here's that outcome column. So you can see 0001. And if I look at the close price, where are we? Let's go back here. There's a lot of data now. So we can see that, here the close price would have gone up in the next hour from here, but in all these time steps, it essentially went down. So this 59542 jumped down to 59491. So that was a 000. If I go back to the right here, we can see here was a 1. So if I go over here, we can see we went from 57097 to 57175. That was a 1. So yes, here's a 1. And interestingly, you'll see there's this missing value. This missing value is very important. What it means is that we don't know what the next hour is because it hasn't happened. There is no next hour. It's in the future, literally. Right now, it's 10:15 p.m. The next hour's snapshot hasn't been taken yet. So it doesn't know, and that's fine. We're going to leave that as a missing value. So what I want to do now is go to the machine learning trainer and run all of this through and see if it can predict what it thinks the outcome should be in the next hour. So let's go and add a prediction to predict an existing feature. This feature is the outcome. It's that column called outcome we added. And now it's saying, okay, well, what do I want to take into account to try to analyze and see if I can make a prediction? I'm just going to say select everything. And I'm going to get rid of all these time ones. Usually I'd get rid of open, high, low, close, volume as well. Maybe not volume, it depends. Usually I'll calculate like a return on volume or whatever. Because volume can be useful sometimes, but I'm just going to add it all in for the purposes of this video. And then it's a classification algorithm because we're predicting 0 or 1, just like if I was predicting if a team won or lost, or if it's a cat or a dog, that's a classification. If I was predicting the price of Bitcoin or a house price or whatever I'm running through here, then I would use something called regression. So here I'm using classification, and 99% of the time that's what I use. And here I'm going to carve out 20% of the data. So let me explain what I'm doing here for you very quickly. What this is doing is if we look at our data set here, and in terms of time, it's going from old to new. That's the direction of the data. I'm carving out, say, 20% of this data because I don't want the machine learning model to look at it. And the reason for that is I want to train the machine learning model on this section of data here, right? That's what I want to do. But for those of you who know machine learning, for those of you who already know how this works and are curious, another 30% of that data here, and I'm going to put it in a different color, let's make it, I don't know, green, is also carved out for testing purposes, right? So in terms of splitting the data, let's just make it a bit more like this. This 30% is actually being carved out, not for training, but for testing purposes within the algorithm. So what's actually happening here is the machine learning model will use this data set over here, and it will test its logic on stuff it hasn't seen over here. And it's going to build itself up and come up with rules and then try to come up with the best rule that allows you to predict what's going on. Once it's done that, then it'll take this data that it's never seen before and spit that back out to you in a file format that you can pull into Excel or load in for backtesting with the probabilities that it's calculated for it to be a 0 or a 1. So it's really powerful. It does it all in one go. Now, the bigger that I select this percentage here, so if I said I want 50% of the data, then I've got less training data. So the secret here is to get a lot of data for training and then spit out a smaller percentage and then use that percentage for backtesting, etc. So that's what I'm going to be doing over here. So if I go back, I'm going to leave this as 20%. Usually I have it at 10, but I'm going to leave it at 20. And here I've got time series. So all this means is, do I want to split the data based on the sequence because it's a time series and that can be important? Or do I want it to chop up the training data randomly? Think of it like that and test it, in various configurations, which if you're predicting, say, whether what football team will win something, etc., which you can do using this, then that's how you would do it. So that's fine. I'm just going to use time series and just start training. And it's phenomenally quick. I mean, it's pretty much done already, and it's given us some results. So if I scroll down here, the results look abysmal. And interestingly enough, the lower Bollinger Band, it found the most useful to try to predict the next hour, which is kind of interesting. And truthfully speaking, these results, they look terrible, but they definitely look slightly better than random. I mean, I've got a 55% accuracy on predicting down and a 52% accuracy on predicting a 1. And I've got a 0.7% standard deviation. That means it's going to be plus or minus within 0.7%. So already it does look like I have some kind of edge over here. Now I've only gone back as far as the 1st of April, but this is pretty interesting. Now I can actually download the file straight from here, but what I'm going to do is just show you what has happened here. So it's saved an additional 2 files. This one is for the prediction of what we're trying to do. So it's the prediction file. If I just refresh this very quickly so you can see what that looks like, it looks a lot like our original data set, except there's far fewer rows. Before we had like 5,000 or 6,000 rows of data. Now it's got 1,000. So this is that 20% that it's returned for us. And on the very right, it's actually given us predictions here. Not only that, and this is what I love about it, I get very excited about it. This machine learning model also gives us what the probability is that it thinks will be a 0 or a 1. So for example, we know what the outcome was, right? We know what it was. The machine learning model didn't. So here's how it predicted it. It gave us these predictions here. And this one with a missing value, which is the next hour, we don't know what it is. Well, the machine learning model is telling me it thinks it will be down based on all the information it has. And the probability of that, again, according to the model, is 56%. And the probability of it being up is 43%. So what I'm going to do is I'm going to take this data set, I'm going to feed it into a backtesting algorithm, and it's just a very quick and dirty way to do backtesting, and for me it's just very convenient, so I'm going to use that. And so I'm going to use this backtrader here to do that. And so I've got the BTC pred classification file, and that's what I'm going to use to try to place trades and see would I have made money since the 1st of April or not. And so what I'm going to do is select value comparison because I wanted to place a long or a short trade based on an actual specific value of one of the columns. And here I'm going to choose the probability of it being 1. And the look back is 0 because I wanted to look at that current time step. So what it'll do is it'll go through, for backtesting, each row of data. If I put, look back 3, it would look at this current row of data, then it would look back 3 time periods to look at the value for reference on whether it should place a long or short trade in this time period. But to keep this really basic, I just wanted it to look at the current time step. And if it's basically greater than 0.5, I want it to go long. So you'll see here, it's actually added that in. Now I could add up to 5 longs, 5 shorts, 5 closes of the longs, 5 closes of the shorts, different combinations of conditions for placing long or short trades, but I like to keep it really simple. And I'm going to do the same for the probability of it being a 0. If it's greater than 0.5, I want it to sell short, and I want to add that in as well. So here, if it's a probability of 1 greater than 0.5, it'll go long. If it's a probability of 0 greater than 0.5, it'll go short. And down here, for the close-end periods, I'm going to use 1. What this is this is a catch-all for all trades, right? So for example, do I want it to just automatically kill a trade and close at whatever the price is in the next hour? Well, that's what I want to do here because we're trying to predict the next hour. So that's what I'm going to do. I'm going to add in this. I don't have to. I could add special closing conditions in, but I'm just going to use that. And when I go up here, I want to use this close price as the price to trade based off of, because the algorithm needs to know, well, what price are you trading? Well, it's the close price. That's where I'm assuming I'm going to buy at. That's where I'm assuming I'm going to sell at. And in terms of commission rates, etc., right now I'm going to put all of this to 0. Normally I wouldn't, because commission is actually what costs money. It's actually what most of the time makes you lose in trading. But I'm going to put all these rates here to 0 just to prove the point about randomness. I'm going to allow up to 4 trades and allocate 80% of my capital per each trade. And if we get lower than 20% of my capital, I will stop trading. So that's what I'm going to do. Let's run the backtest. Okay, so I'm going to scroll up, and what I would expect is once it's gone through every row of data, I would expect it to return some results, including a PDF report that I can go and analyze to see how was it successful, was it successful, and why was it successful? And is this something that I would rely on to actually trade with in terms of this specific algorithm? Now, funnily enough, it actually did come back profitable. So we had a win rate of 52%. This win rate's important. It looks at how many trades were profitable versus the total trades. If you're doing like options trading, that's actually a very important number. The Sharpe ratio is abysmal. The Sharpe ratio looks at what are my returns against how volatile is it. So you want that number to be as high as possible. It's not negative, which is good. And we made a net profit. You know, we actually made, since the 1st of April, 14.8%. And the ROI versus buy and hold is actually better by 10.6%. So if we just bought and held, we're actually better off using this strategy, assuming no commission costs or slippage, etc. So not a realistic scenario, but this actually did work. We beat 50-50 odds, which is quite interesting. When I look at the PDF report here, there's something that I always look at that I find really, really quite interesting. And that is this partial autocorrelation. So ignore the first 2 bars, just always ignore those first 2 bars. When I look down here, anything which reaches up to 0.2 means that it is not random. What that means is autocorrelation basically is comparing the correlation of something against itself. So when you shift it by n time periods, how does it compare to itself? Is there a correlation it can find that leads us to believe it's not completely random? When it sits below these blue lines, what that largely means is it's pretty much completely random. But nonetheless, this actually worked. So, you know, we started off with an account balance of 5,000. The account balance dropped below 4,500. And then it went up and ended up above 5,500, right? So we can actually see the results there. There were a lot of long trades and a lot of short trades. So if you got, say, you know, a market making rebate, which is really, really important if you're trading, because it actually means the odds are going into your favor. The more often you're trading, if you are in a neutral type strategy or close to neutral like this, then actually you should be making more money. So if I was to run this strategy again with a rebate, you would see that the profit should be actually a lot higher, which is quite interesting. And there's just some metrics at the bottom. So that's really interesting. We've beaten 50-50, and with Bitcoin, it can be hit and miss. I mean, Bitcoin is largely very random, but can we find something else which is, I don't know, less random than Bitcoin? Well, I'm going to run all the same analysis again very quickly. I'm not going to talk through it this time, but I'm going to run it for, you know, something called CVP. And I'm going to tell you why near the end, why I've done that. But I'm going to run CVP USDT. I think we did 1st of April. So let's do that again, just so it's a fair test. And we're going to run the hourly data. And I'm going to run this as CVP, just so I know what file is Bitcoin and what file is CVP. So let's go over to our data engineer and find the CVP file. In fact, I'm going to delete these Bitcoin files here just because, you know, we've recorded this, we've proven our point, and I want to make some space. So I'm going to run this for CVP and just add in, I'm not even going to add in much. You know what? All I'm going to add in is the daily log return. I'm not going to add in any technical indicators whatsoever. What I might do is add in maybe I'll add in some sequence. So actually what I'll do is I'll take this daily log return and I'm going to add in, say, up to 10 days worth of sequence. the maximum, and I'm going to add that on. And then the last thing I need to do is just go and add in the outcome column. Same thing we did before. If the next hour was up, then show a 1. If the next hour was down, then show a 0. And let's label this as outcome. So when we run that, we should be able to refresh it pretty quickly and now run the machine learning against it. So let's predict that outcome column and train the model to do that. And then in terms of the features I wanted to include, I'm going to include all of these features here, but I'm going to take out, the quote asset volume, the number of trades. Number of trades I'll leave in, the rest I'm just going to take out for now and just leave these log returns. That's it. And the number of trades. No technical indicators like technical analysis indicators, nothing. I'm just going to run it like that. Again, I'll return 20, I'll reserve 20% of the data for like back testing. And let's go and have a look and see what that looks like. So this is pretty interesting, actually. When I look at the model, first of all, it hit about 50% accuracy on the first go. And then we ran it through this thing, which basically does it like 3 different times and chops and changes it and works out that on average, you should actually hit 55% with a 1.7% either way, sort of standard deviation. And what you'll see here is the daily log return. So in other words, the change in the close price from the last hour till now, it says daily log return, but this is on hourly data, right? So it's hourly log return, is by far the most useful feature. In fact, if I was to run this whole thing again from scratch, in fact, I'm going to do that. Let's just run this. Let's just run CVP and let's only use that daily log return. Let's use nothing else. So just that daily log return. And let's run it again. Let's reserve 20% of the data and actually see what that comes out like. I'd be interested. It actually performs much better to a degree. It performs better. It does much better on predicting the zeros, so the down days, and not as good in predicting the up days, basically. So you could play around with this to see, can you find the best fit? But this is looking pretty interesting because what this is saying is it's finding just that 1 day's return does actually make a difference to how predictable this crypto is. And this is far less liquid than Bitcoin. I mean, you might not have even heard of this CVP coin until watching this video. In fact, I don't even know what that coin is and does. So I'm going to go here to the back trader and I'm going to do the same thing we did before. I'm going to select the CVP prediction column and I'm going to choose, let's say, predicting an up day. If it's greater than 0.5, place a long trade. And if the probability 0, in other words, of being a down day, is greater than 0, then place a short trade and close all trades, in the next time step. So here we've got the same thing we had before for Bitcoin, and we used, I think, the close price, and we got rid of all commissions. Let's keep it all the same, run the backtest, and see how this would have performed. Okay, so interestingly enough, we got a win ratio slightly lower than Bitcoin's, which is interesting. And I wonder, had I added more technical analysis indicators onto this, would I have got a better result? Well, it would be pretty quick to find out, but I think this video has been long enough. Now, if I actually look here at the report of what happened with the CVP, this could be quite kind of interesting. So here we actually had a much better slope up than we did with Bitcoin, right? So we started at 5,000, we ended up at just above 5,500. And so this is our account balance. This is what happened. And here's the price of CVP. So this is the account balance against the price. So we can see that we caught some of the really good swings here in the price in the right direction because we were trading both longs and shorts. Maybe we got lucky here and here. But even so, we beat the market. The market was kind of just below neutral. And again, we were up, which is really interesting. Now, here's the partial autocorrelation. And this is something I find really fascinating because this looks a lot stronger than Bitcoin's. Now, it's not to say that there's not a lot of randomness going on here. There's a tremendous amount of randomness going on here. But if we look at this price sequence, we can see we're starting to break this barrier towards the 0.2 mark for these prior days. In other words, there is some predictability in the sequence, probably, of this coin. And so for me, this was really interesting. And the way I found out about CVP is I ran this partial autocorrelation in Python against all of the shortable and longable, all of the coins on Binance that you can go short on or go long on, to see which ones came back with a favorable partial autocorrelation. And that, this coin was one of those. So, for me, this goes to show that yes, the markets largely follow a random walk, but there is some determinism going on here. I've just run 2 very quick slapdash backtests, no on-chain data, right? No weather data, no political data, no S&P 500 data. I could have joined all of that on here using the platform or in Excel, and I could have tested a lot more to try and gain an edge. Sentiment data, you could add in all of that. And already, we're beating 50-50. So here we used quantum computing. We ran some backtesting on Bitcoin and CVP. We ran machine learning. This video was way overdue, and I hope you really enjoyed it.